Hello everyone, welcome to CAIIB English Medium by Officers Adda 24/7. This side CRT and I hope your CAIIB November-December 2024 preparations have been already started. If not yet, then do use this type of series because this particular series provides you the concept along with numbers of MCQs questions based on this particular concepts. So today is your unit 14 in which we are going to talk about discounted cash flow valuations, correct? But before knowing how to calculate the discounted cash flows, we need to understand that what is discounted cash flow. But before we start today's session, let me tell you one thing, that if you are a new visitor to our this particular channel, then surely subscribe it because we provide you the planning strategies like special series so that you can clear your CAIIB, GAIIB, bank promotional exams in your first attempt only. And do like this session because in this sessions I'm going to tell you how to use your calculator, how to solve the numericals based from this topic. And surely share these sessions with your friends and colleagues so they can also get the benefit from this special series. Chali. So let's start with the understanding of discounted cash flow. We call it as DCF. Okay? We call discounted cash flow as DCF. Now what is DCF? It is a type of a valuation. It is a type of a valuation method in which we are actually finding out the value of any asset. Okay? It is a type of a valuation method in which we are finding out the value of any asset by, the main thing starts from this, by present value, expected future cash flows. Whatever incomes you are expecting in the future, whatever incomes you are expecting in the future, we are discounting it at today's time period. This is what discounting means. In this particular unit, we are going to identify the future cash flows from your assets, from your different type of investments. That what are the benefits we are going to get from that? What are the incomes we are going to get from these investments in the upcoming years? But as you know, every year we are seeing the inflations, correct? We are seeing the risk. So many things are present in the economy, not only in the economy, but internally in the businesses also. So for this, we require the perfect answer, which is after adjustment of other factors also. So for that, we discount the cash flows. We give the effect of interest in the cash flows. Chali. So in this, suppose you are investing in any particular cash flow. Okay? For suppose 1, 2, 3 years. Today is your zero time period. At this time period, you are investing 1 lakh. Every year, they are saying that you are going to receive after this investment interest. We can call this as 10,000. Means at this first time period you are going to get the 10,000, again at the second time period 10,000, third 10,000. So this is just the absolute number which is not at all affected by your inflation, by any risk, correct? But the true sense of calculating any value is after giving the effect of your risk, inflation and other factors. That is the true value. And in this unit, we are learning how to identify that particular true unit. Okay? So remember, in this we need to solve by discounting. We need to solve by discounting. Like this, we need to calculate the future cash flows, 10,000, 10,000, 10,000. Today's value. That what is the value that currently as a layman, we can say that we are getting 30,000. So is it 30,000 only? or something else if we adjust with the risk and with the inflation. That is why we need to understand that whenever we are valuing any assets, okay, whenever we are valuing any assets, we need to discount it, your future cash flows at today's time period. That is your present value. Correct? So this is all about your discounted cash flows. Chali. Next in this, we need to see the different terms that we are going to use under this. Like, number one is your present value concept. As I told you, present value concept is what? Whatever you are investing today, whatever you are purchasing asset at today's time period, with that investment, with that purchase of assets, you are going to get the future cash flows. Na? As I told you, 10,000, 10,000, 10,000. It can be for n number of years also. Okay? Generally, in this, right now I'm taking the example of 3 years. Correct? So, it can be any number. It can be any life. Depends on the questions, what they want to ask. So, currently we are going with the total life of 3 years. Okay? In this, we are going to get 10,000, 10,000 and 10,000. So, this 10,000, 10,000, 10,000 that you are going to receive each year is your future cash flows. Correct? If you are standing at 0 time period and you are estimating that, okay, after 1 year I'm going to receive 10,000. After 2 years, again I'm going to receive 10,000. After 3 years, I'm going to receive 10,000. But you are standing where? You are standing at this 0 time period. Means all these 10,000s are your future cash flow. And you need to calculate today's value. You need to calculate today's value. Whenever you are calculating today's value, after adjusting the inflation's risk, apart from other things, that is your present value concept. Okay, I hope this is clear now. Next is your risk and discount rate. As I told you, that whatever you are receiving during the future time period, that is not true value. Generally, as a layman, we directly say 30,000 is our return. But after knowing the inflation's risk return, now we understood that layman language 30,000 is not a true value. For that, we need to use the risk and discount rate. Correct? So this rate is used in DCF various based on risk and your discounting or other factors for the asset. So next term that we need to understand, next we can say the value. We need to understand under DCF is your risk and discount rate. Correct? Next is your intrinsic value. Whatever you are going to calculate now after using the discount rate, whatever present value you get after the discounting, that is your intrinsic value. Okay, that is your intrinsic value. Now at the present you have two values. At the present you have now two values. One is the actual value that you are getting. Okay, that seller is offering you. Okay, that is one value. Next value is your intrinsic value that you calculated with the present with the future value, cash flows with the discount rate. So at present now you have two values. One that is offered by your seller. Next is what you calculated after doing the adjustments of risk and different factors. So in this, we need to compare these two things to identify whether our investments are profitable or these investments are loss-making. Okay, so these things we use to calculate the DCF. And the last thing is valuation complexity. Under the DCF models now we have different methods to calculate it. And in this unit we are going to see what are the different methods that through which we can actually find out the present value through which you can value any firm. Chali. Next we are going to start with estimating inputs. What are the estimating inputs for applying the DCF method, correct? Valuing a firm or any other assets, what are the inputs you require? So before that I told you different terms. Okay, before I told you different terms. What are the different terms that we can observe in any cash flows during this DCF model? Now I'm going to tell you, are these terms are enough? No. Those the previous terms that I told you are giving you just a definitions. But now, what are the terms we are going to use for the calculations that I am going to tell you? Okay. So first is your predicted cash flows in the future. First, we are going to talk about predicted cash flows in the future. Next is your discount rate that is suitable for the given level of risk associated with this cash flows. Next, we have estimated cash flow growth rate and estimated pattern of growth. Just wait a second. I'm going to tell you each and everything. Don't worry. Don't worry. I'm going to tell you each and everything. The first is your expected cash flows. Expected cash flows means that you are going to receive in future. Correct? Expect, estimate. Expect, estimate that you are making for the future cash flows. So how we can estimate the future cash flows? Now this depends on two factors. That is A, free cash flow to equity, and next one is depends on your firm. How you can expect two cash flows? You can expect the cash flows based on two things. Okay, one, you can use the cash flows to equity. Next, you can use to the firm. So these are the two types. Okay, chali, one by one we are going to see. First, we are going to talk about free cash flow to equity. Equity means owners, correct. Your owners, what they are getting. Okay? Any amount which is freely available to your equity holders is known as free cash flows to equity. Under the free cash flows, you can use two different things. One is your free cash flows to equity. Next, you can use free cash flows to the firm. In case of free cash flows to the equity, in this we are going to see what is the actual amount that is available to your equities. Now, for the calculation of this, we require the income statement. What is income statement? Array we have already seen under our leverage unit. Already we have talked about this income statement. So if you don't know what is income statement, I request please watch my leverage unit. In that already I have discussed that what is income statement. What are the things that we need to consider for the calculations? Chali. So in this I'm going to tell you the brief one. Okay? I'm going to just tell you the brief that in this you use the earning available. Acha chali. Let's start from EBIT. Okay? Earning before interest. This earnings, what you get, from this you deduct the interest, from this you deduct the tax, correct? After this, whatever you are getting earning available to equity share holders, that earning we are going to talk about, because this earning is available purely to your equity. What about preference shares? If preference shares are present, then do subtract them also from this income statement before distributing to your equity. Means after giving every expenses, every liability deducted from your incomes, the final amount that you have in your hand, that is your free cash flows to just equity. And whatever models we are using for FCFE, free cash flow to equity, we call it as FCFE discount models. Okay? Next is your free cash flows to the firm. Now, whenever we talk about the firm, now firm includes the wider term. Firm includes the wider term like equity, debt and preference stockholders also. Means under the firm, we are not going to talk about any specific shareholders or any specific debtors or debentures. Okay? In this, you include your equity portion also. In this, you include the debt portion also. When you combine, when you calculate the total amount for the firm, before deducting the interest, before deducting the preference, before deducting the equity amount, that is your free cash flows to the firm. And the models we are using for FCFF, we call it as FCFF model. I hope this is clear. So these are the two ways you can expect, you can calculate the cash flows. Don't worry, we are going to see the example also. Chali. Next is your discount rate. As I already told you, for the discount rates, we need to adjust the different internal, external sources, different risk, different scenarios, correct? For understanding, we need to include all these things. So majorly, we divide this risk with two perspectives. One is your default risk, next is your market risk. Default risk means in case of failure, what are the chances of failure? We need to understand this, and we are going to add this risk. Okay? The possibility that a borrower may fail to meet the financial obligations, this we need to add in your discount rate, both while he is paying the interest or while he is paying the principal. What are the possibilities of the default? So that we need to adjust in our discount rate. Along with this, we need to use the market risk. Market risk is actually the difference between the actual and the expected returns that you are going to get. Okay? The final difference that you expected and the actual return that you are getting is what your market risk. Okay, so this is how we calculate the discount rate. So discount rates that determines the present value of future cash flows, as I already told you, by using a rate. By using a rate, that is the cost of capital, which says most accurately that reflects the risk and the timing of the cash flows. We are using the rate through which we are discounting our future cash flows to know what is the value at today's time period, whatever expected cash flows you are getting. So this is all about your discount rate. Chali. Next is your next is estimating future growth. Next is your estimating future growth. See, whenever we are investing now, we are not only getting the one constant amount. Okay. There might be growth in your returns also. There might be increasing in your returns. Like first year you are receiving 2,000, next year you are going to receive 4,000, third year you are going to receive 10,000. Means you can see the growth. Like what? Suppose again 3 years. So in the first you are going to receive 2,000, next you are going to receive 4,000, after that 6,000. So what you are observing in this, that our returns are growing, correct? So this is what? This is your growth. And this growth you are observing where? In the futures. In the futures. So whenever we are estimating the growth in your future, that we call it as estimating future growth. That we call it as what? Estimating future growth. So in this you can understand with the help of revenue and expense growth, inflation and growth rates. So ultimately what we are doing, the first thing you can understand the growth with the help of revenue and expenses. Okay? Whatever estimates that you are required for the revenues, whatever revenues you are thinking that acha, you will be earning after this, after the sale of this particular unit, like 10,000, 2,000, whatever amounts you are expecting. This growth you are calculating with the help of your revenues after adjusting the expenses. To this you can also calculate the growth, or you can use the inflation and growth rates. Means in the inflation market, any inflated market, how you are going to understand that which type of growth. I'm sorry, just give me a moment. Yes. So in this, whenever we are keeping in mind the inflation and the growth rates, then we are going to call it as inflation and growth rates. And in this, different methods are also there, like historical growth rate, like what we were doing in the past. After considering the past performance, past analysis, we are making our future growths. That is one. Next is your analyst, means now we are estimating. Firstly, you can understand about your past performance, and based on that, now we are expecting our future growths. Okay? Or you can do, you are going to directly think about the future. You're not using the past performance data. Directly you are analyzing, you are taking the help of the experts, and with that you are analyzing the future growth. These are the two ways through which you can understand. Now, next is in this is your growth patterns. Based on our growth patterns, we decide which model we need to use for the calculations. Yes. So, pattern means what? Pattern depends on so many things. Are you getting the stable growth? Like every year you are just seeing the 2% growth only? Correct? Or you are seeing for some time period some steady growth, and then like this. Means this time you were observing that every year you were increasing by 2%. But after that, your constant growth rate is there. There is no increasing in your growth. Or you can see that your growth is increasing. Okay? In a 3 slots, like there is one time growth is there, next growth, and after this your growth is constant. So these are the ways through which you can decide a pattern. Or also you can get just a single constant growth. That every year we are just getting the 10,000, 10,000, 10,000. In this type of one-time growth, if changing, okay, like this 2% one for a few years, and after that it stabilize. I mean, it's get the stable, like constant. Like in this you are getting 2% increase, and after this if you are getting just 10% for the life of that investment. These type of growth pattern shows that this is your two-stage growth rate. Okay? This is your two-stage growth rate. Correct? And in this kind of growth rates in which you are seeing the 2-time different changes in your growth rates. Before means in initial starting years you were getting 10% growth every year, but after that you are declining with some amount, or you are increasing with a less amount. Okay? And after that you are going to see a constant stable growth rate. Means in this you are changing, you are seeing the change in your growth rates. That is what your 3-stage model. Okay? Or we can call it as N-stage model also. Chali. Now, after this we are going to see, under this DCF we are going to use the dividend discount model. Under this we are going to use dividend discount models for the calculations. Okay? So what are the various dividend discount models that we can use for the valuations? Number one is your constant growth model. Correct? Next we use for the calculation is zero growth model. Next is your 2-stage model, H model, and 3-stage model. And all these different types of your dividend discount models are numerical based topics. Okay? In each of the topics we need to calculate the amount. So remember, basically from this particular unit the important part starts from this topic. The important, if you ask me that what is important in this particular unit, then the important thing starts from this particular unit, because in this we need to calculate different types of cash flows, that too in a present way. Okay, chali. So one by one we are going to see. Number one, we are going to start with constant growth model. Number one, we are going to start with constant growth model. Chali. So what is constant growth model? What is constant growth model? In this, whatever you are expecting in year 1, okay, whatever growth you are expecting in year 1, that will be constant for the life of that investment. Means never you are going to see any change in that. ठीक है, if at the time of issuing of any investment that you are making, they said that your investment amount is suppose rupees 2 lakh, ठीक है, and every year you are going to get the rupees 10,000, but you are going to increase the value by 10%, and suppose life is 3 years, okay. So what you can tell to what you can understand from this, that in your first year you are going to receive 10,000 for sure, okay, but in the second year you are going to receive 10,000 plus 10% of 10,000. This is the final amount that you are receiving. So this amount of 10% into 10,000 is your growth. Okay, that is your growth. Next is your, again in the third year, because life is 3 years. So in the third year, you are going to receive 10,000. Okay, the basic amount. And in this, you are going to get the 10% of 10,000. 10,000 plus 10% of 10,000. So this is what your constant growth rate. This is what constant growth model means. Every year you are going to get the 10% only. Okay, so this is how we calculate the constant growth model. Chali. So based on this, we are going to solve. But what is the formula ultimately are we going to use? See, in exams, we need to save the time. We need to solve fast, and that to the highest accuracy. Correct? So we are not going to calculate like this. Okay, we are not going to make any time frame. We are not going to calculate each year's cash flows. We are going to use the formula. What is the formula? Please don't retain this type of formulas, because these are very, very lengthy formulas. And in exams, we have only 2 hours. Okay, so you cannot use these formulas for just one question which is having 2 marks or less than that. So for that, we need to be very smart. So we are going to use this formula. P0 equal to D1 divided by R minus G. I'm going to tell you what all these things are. See, P0 is your today's price. Okay? Today's price is your P0. D1 is your next year's dividend that you are going to receive next year. Okay? We need to calculate today's amount now. We need to calculate today's amount. So in this, we are using the next year's dividend divided by R. R is your rate. Discount rate? Correct. Rate. G is your growth. Growth that we have seen, that we can observe the increase in that. There will be a constant 2 stage, 3 stage. Are we going to receive the increase amount or something? Yes, that is what growth. Okay? So in this, we are going to use this formula. Chali. So based on this, we are going to solve one question. XYZ Limited is expected to pay a dividend of 3 per share 1 year from now. The dividend payments are expected to grow at 5% per annum. If an investor needs 12% rate of return on his investment, what price of the share will be considered to be fair by? Means in this, they want to understand that whatever XYZ company is paying to this particular investor, whatever investments that person is thinking, if profitable or not. So for what we are going to use, we are going to use the formula. D1 divided by R minus G. Okay, if you read the first line, they are saying expected dividend 1 year from now. So this is what? Today's dividend? No, this is after 1 year dividend. Means directly they are giving you D1. That is your rupees 3. Okay? Next is they are saying expected grow. Grow means your G. Your G is 5% per annum. And I told you for the discounting, we need to use the rate of return. Okay, we need to adjust with the inflations. So your R is what? 12%. So what just we need to do in this, we need to put this inputs in this formula. So D1 is your 3. Okay, R is your 0.12. Growth is your 5%. I hope you know how to write all this percentage into fractions now. What is the percentage of this? The fraction of this 5%, that is 0.05, or 5 divided by 100. What is the fraction of this? That is 0.12, or this is the way we write this. Correct? Chali. So what is the answer? 3 divided by 0.12 minus 0.05 is your 0.07. Okay, that is your divide equal to 3. That gives the 42.86. This is the fair value. This is the value. Truly describe this investment. This is the value which says that whatever investments you are getting, whatever investments you are going to get, or you are thinking, you are estimating in the future, the ultimately amount is 42.86. Okay, the ultimately value of this investment is 42.86. I hope this is clear. So based on this, now question for you all. Now you are going to tell me if in this the actual, okay, in this actual current market price of XYZ companies, they are selling this particular investment for suppose 50. Acha chal, not 50, for 150. And after the calculations, you got to know that true value is only 42.86. So as a smart investor, as a we can say a very calculative investor, are you going to purchase this kind of shares or not? You are going to tell me this answer. Okay, sorry. Now, next is your zero growth. Now, what is zero growth model? In this, if the event is the dividend per share stays the same from year to year at a value of D, the formula will look like this. In this, they are saying from the day one, whatever you are receiving, suppose 1,000, you are going to receive 1,000 lifetime. Okay? You are going to receive 1,000 for lifetime. Sorry. Based on this illustration, you are going to check this method. XYZ Limited is expected to pay a dividend 3 per share 1 year from now. The dividend payments are expected to remain constant, that is 3 per year. Okay? Again, they are saying that your investment, your expected dividends will be going to remain constant. If an investor needs 12% rate of return on his investment, what price of the share will be considered to be fair by him? In this, they are saying that what is the actual value, what is the actual price? Again, in this, we are going to use the formula, that is D divided by R. Why we are not taking the D1? Because in this, we are not going to expect any growth. Okay? We are not going to expect any growth. If you are thinking that what formula is this, you can use this formula also. The previous one formula. Remember, this 3 is your constant. Okay? This 3 is your constant. Means every year you are going to receive the 3. In this, your rate of return is your 12%. In this, they are giving any growth? Nope. So directly you are writing in place of G just a 0. Or you can directly write or 3 divided by 0.12. You can write with this. If you are not understanding what this formula is, you can use the previous formula also. Okay? But remember, in the place of G, you need to put this 0. Please don't assume any value. Don't write any value based on your assumptions. Now, chali. So answer is 3 divided by 0.12. So your final price is rupees 25. Final price is 25. This is how we need to calculate. So we have seen the two dividend discount models. Okay, number one, constant growth model. Number two, zero growth model. Chali. And now we are going to start with some questions based on our topic. Okay, chali. So present value indicates what? A, value in use. B, the value of cash flows expected in future. C, value computed using the internal rate of return. D, the present value which a buyer is willing to part. Yes, tell me. In this, they are asking, what is the present value? Indicates. So the present value indicates the value of your cash flows that you are expected in future. Okay? The final value, it shows the value which you are going to expect, you are going to receive in the future. So correct answer is B. Chali, next question. Under the discounted cash flow valuations, which of the following is typically employed as the discounted factor? A, cost of equity, cost of debt, C, annuity factor, D, overall cost of capital. They are saying whenever we are calculating the cash flows, okay? So generally what we are going to use after solving the two methods, what you understood? What are the things that we use for the calculations? What type of factor we use for the discounting? In that, we use the overall cost of capital. Remember this. Whenever we are calculating now, we are using the overall cost of capital. They are not asking you the expected cash flows. Okay? They are not asking that equity and the overall. They are asking that what factor generally we use for the calculations, for the discounting. So in that we use the overall cost of capital. Okay? Chali. So I hope the two models that we discussed today actually clear to you all. And if you want to know in detail, okay, what are the other models and how to solve that, because all the five are very important for your exam point of view. And if you want to solve all the models, then you can enroll in our batches. Okay, for that you can use the Adda 24/7 app. As soon as you visit there, you can see that CAIIB Mahapack, and we are recently going to launch the crash courses also. Okay? Otherwise, if you want to know in detail, then you can use our bilingual batches also. That is Kranti for the bilingual, and for the English candidates, we have the Revolution batch. Okay. But ultimately, if you ask us that what is the ultimate source, that one-time investment will be providing us the benefits, I mean so many benefits. Is there any type of that sources? Yes, the answer is your CAIIB Mahapack 2.2. Because this CAIIB Mahapack provides you all the detailed classes also, all your revision classes also, all your future batches also, or your any special batches we launch for your preparations. Everything is freely available just by one-time investment. Along with that, unit-wise test, mock test, full-length test, everything is available. Along with test series, 245, 302 ebooks and 1500 plus videos we provide in this. So how you can enroll in this? You need to click on buy now. As you can see, currently you are getting the 75% off, correct? But if you are targeting to clear your CAIIB in your first attempt, so in this we are providing you some special benefits, like using the code Y895 can give you and will give you the extra off, because we know that your dreams are very important, that your targets are very, we can say, determined. So we are supporting in these situations. So you can use the code Y895 and you can get up to 77% off. But remember one thing, if you want like more opportunities, if you want more discounts, then you can use the Adda 24/7 app. By purchasing this same Mahapack through this Adda 24/7 and using the Y895, you are going to get the double validity. Along with this, your total discount will be 78%. Remember, just by using your app, you can increase your discount also and you can get the double validity also. Sorry. So let's wind up this session. Thank you everyone for joining, and do share your answer, okay? Because I already asked you one question in today's session. I hope you understood what topic is, what are the formulas we need to use. Thank you for watching.